Manulife shares, which underperformed for a long time, now becoming one of the best performing names in the Canadian financial sector, with the stock at its highest level in roughly 15 years. For Gori, it was all part of the plan. We sat down with him in an exclusive interview at Manulife's headquarters, and he outlined what it took to get to this point.
We certainly do have traction and momentum, and it's been several years in the making. You know, we've worked to really transform our company. We started that journey in 2018. We set a goal for ourselves. We wanted to be the most digital, customer-centric company in our industry, but we also knew that we had to de-risk our business and improve the returns. A large part of our focus went into 5 priorities. We decided that portfolio optimization and the return on our capital was critical, driving expense efficiency, accelerating growth in our highest potential businesses, digitizing customer experiences, and then finally making sure that we had a world-class culture and team. So that's been our focus, and I think in 23 we saw really all of that culminate into some tremendous momentum and results. We delivered some tremendous operating results, 17% core earnings per share growth. Our return on equity got to nearly 16%, up 5 percentage points from 2017 where it was about 11%. And then we closed a historic long-term care transaction, in fact the largest long-term care transaction ever in history, and that I think really showcased that we are a radically different company to the one that we were, and that's certainly been reflected in the stock price and the appreciation. We've just announced our Q1 results, and I think we're able to also demonstrate a continuing of that momentum for our results this year so far.
And I want to talk about some of that momentum, but you highlighted some of the big things that you've been thinking about. There has definitely been a market taking notice of these large reinsurance deals you've done, which at the core seem to be about shifting away from lower growth and freeing up a lot of capital. For those who aren't quite familiar with the mechanics behind those big deals that you've done now, can you walk us through that?
Yeah, John, you're absolutely right. Again, under the umbrella of portfolio optimization, we realized that we have to improve the returns of the franchise. We had a lot of our capital dedicated to risky businesses that were low return. So we've been divesting those businesses. As at the end of Q1 of this year, we'd divested and freed up $11 billion worth of capital. And in the process, we'd actually redeployed that capital to our organic businesses that are delivering much better returns. And we've also bought back a lot of stock, again, delivering value for our shareholders. So by divesting those businesses, what we're able to do is actually improve the return profile of the business and take a lot of the risk, which was creating volatility in our stock and ultimately our earnings, away, and therefore provide a more compelling reason for folks to invest in Manulife.
And with the results themselves, what continues to stand out is your strength in Asia. It's not a new market. Manulife has been operating in Asia for many, many years. Of course, you were running that business before you stepped into the CEO role. Asia is a fairly general way to describe a part of the world that you guys are focused in, including multiple countries. Maybe you can explain why Asia is seeing momentum for Manulife.
Well, I'd start by saying that we are a very unique business, and I think there are very few companies that have our business footprint and business mix. We have tremendous businesses here in North America. In Canada, we're a leading insurer and wealth management provider with tremendous profit growth and returns. In the US, we're very uniquely positioned around providing behavioral insurance as an offering, and again, generating great returns, great capital generation. But as you highlight, our strong focus has been around growth in Asia and wealth and asset management. And in Asia, we've operated for more than 125 years, so we've got a really good track record and credibility in that part of the world. And we're a leader in Asia, being a top 3 player. We were top 6 in 2014, and we've steadily grown to the scale where we're now a top 3 player, which means that we can actually compete at scale. So Asia is a real important focus area for us. We've delivered great progress and results there, but Asia's continuing to grow. Insurance and wealth penetration is still very low, so we see a lot of opportunity there, and it's a big part of the focus as it relates to our organic growth and opportunity.
And so if people are trying to get a sense on the profitability breakdown of Manulife, if you go out a few years from now, what's the ideal mix of business if I'm thinking about the profitability breakdown for the business around the world? How much could come from Asia in your opinion?
So one of our strengths is that we're not relying on one market or one geography. So I think a great power comes from having a diverse business that has the ability to weather storms if there are any in any part of the world. Having said that, the strength that we have in Asia and the growth opportunity that's there just naturally means that Asia is going to continue to become a bigger part of our franchise and business. And we expect that Asia will represent approximately 50% of our earnings in the not too distant future, and that's our Asia insurance and wealth management businesses. So again, Asia's a tremendous asset for the company. It's delivering tremendous returns and profitability, but it's also delivering tremendous growth off the back of the demographics that we see there.
And just coming back on capital and how you allocate capital, and you highlighted, and we just saw with the buyback news, that there's a lot of very specific shareholder-friendly developments that have been announced on that front. When you think about what else you might be able to do with freed up capital, acquisitions, or further fueling organic growth, how should investors think about what the plan is going forward?
Well, the first thing I'd say is that we're in a very strong capital position, and that's a good position to be in. Knowing that you've got a strong capital foundation and that you could weather any storms is firstly something that allows everyone to sleep at night, and that's something that financial institution that's regulated needs to have top of mind. We've done a lot of work to strengthen our capital position. We currently have $24 billion of capital in excess of the supervisory minimum, about $10 billion above our operating range that we have internally. So we're very well capitalized, and we have that as a source of strength. When we think about deployment of capital, obviously first and foremost, we're going to deploy it organically to the businesses that we currently have. So organic growth is our number one priority. Second priority for us is obviously to continue to provide attractive dividends to our shareholders. And then third, we'll constantly look at buybacks as a possible value lever, but also M&A and acquisitions. Now on that front, we want to always be judicious. There's a graveyard full of companies that have done bad M&A deals, and we certainly don't want to be doing that. Having said that, we've set a goal for our growth of about 10 to 12% earnings per share growth. And the good news is that given our footprint, we don't need acquisitions to deliver against that growth, which is actually quite high and significantly higher than many of our peers. So that allows us to be more opportunistic and more judicious around the deployment of capital to M&A. But we're in a strong capital position, so if there are good opportunities that are core to what we're trying to do and focus on, we'll definitely consider them.
Capital is very tangible. Culture is less tangible, but when we've spoken in the past, you've talked about the priority, you brought it up again. We're at your headquarters, which in recent years went through a transformation to be more connected to your people. Can you walk us through how the focus on culture has translated into better financial success for the company?
Culture is everything, John. We can execute all the priorities that we want, but it's not going to be sustainable unless you have a world-class culture. So what underpins everything that we do is the work that we do on culture. And I'm proud to say that we've not only done a lot of work in that space, but we've been recognized for that. Our engagement results that we do on an annual basis have us in the top quartile for our culture and for the engagement of our employees. So that's something we're really proud of, but it's something that we don't take for granted. So we're constantly looking to invest in our culture, invest in the quality of our people and the development of our people, not just for the strategies that we employ today, but for the strategies that we're going to need to employ in the next 5 years. For example, the use of Gen AI and new technologies. So culture, I've said many times, is the only long-term sustainable competitive advantage that a company has. We've invested heavily in it. We believe that we've got a very strong culture that's actually driving the results that we're seeing now in the performance of the franchise. And we think that's going to put us in good stead as we look to the next phase of our transformation, which is to take some of these amazing technologies that are going to allow us to create even more enhanced ways to interact with customers and ultimately deliver better value for shareholders.
And I'd love to stay on that subject because the world, certainly the stock market, has been fascinated with the promise of AI, but it seems like a priority for boardrooms around the world. In the technology sector, we have a general sense on how things like Gen AI can be worked into existing products and services, companies like Microsoft. For you, when you're trying to implement new tools or new technology and wanting to make the right steps, the ones that are productive for everyone, how do you go about doing that? What are you thinking about right now?
So digitizing your business is and must be a huge priority for any organization. You just cannot move forward in an advanced way when a consumer wants to interact with you digitally and have paper manual-based processes. And the honest truth is that our industry has done a terrible job with digitizing the experiences for customers. Now that's provided and presented a tremendous opportunity for us because we believe that we can differentiate ourselves from the competition by creating better experiences through the use of digital tools. So that's been a big focus for us, but it's been a journey that we've worked on for at least 6 years. A large part of that has been our investments in digital. We've invested more than $1 billion since 2018 to improve every process that we have and every interaction that the customer has with us. That's meant that our straight-through processing statistics, which is the number of transactions that are digitally processed straight through without any human intervening, it's gone from about 68% to about 85%. And that just means a better experience for a customer, and it means that we're taking away low value, no value work. So going forward, more investments are ahead. We're again committing to $1 billion in the next 3 years, and use of advanced analytics, AI, Gen AI, is going to be at the front of that investment vehicle.
And do you think that's a message that should carry through throughout Canada, throughout corporate Canada? Do we have to move faster to adopt these new technologies to be a more productive country?
I think not only to be more productive, but to compete and create value. Consumers are demanding better value for their money. We see high inflation, really taking its toll on the consumer, and that's affecting their spend habits and patterns, and also their optimization opportunities. So I think as a country to be smarter and for us to drive productivity as a key vehicle, as a country that is, we have to use technology, we have to use creativity and innovation. And I think companies are going to need to really make this a big priority if we're going to really deliver on the value that consumers really want and need.